Let's get more on the markets from Martin Cobb, Senior Vice President Equities at Lorne Steinberg Wealth Management. Great to see you.
Good to see you, Andy.
So the S&P has recovered dramatically since April 8th. The catalyst for that, just Trump blinking on the tariffs?
Yeah, I mean, you go away on a round-the-world cruise on the 31st of December and you come back today and you think, what's all the fuss about? But yes, the fact that we're talking about 30% tariffs on China, which I think 2 months ago would have been seen as really bad news, is now seen as be slightly more positive news. So here we are. Markets have certainly perked up since I was last year. I was talking about the sell-off, the opportunities. We're flat year to date, but a lot of damage has been done. Uncertainty, confidence, etc. And that's still going to flow through and hurt the economy and hurt corporate profits to some extent.
Right, there's a delayed effect here. Loblaw, you may have seen, warning now that prices are going to go up because they've got run through a lot of the inventory that was tariff-free previously.
Yes, I mean, you walk into a supermarket in Canada now and it's got Canadian flags, you're going to have signs with T's. I mean, it's bamboozling. You know?
Yeah.
But yes, lettuce, tomatoes, avocado, pork, beef products, etc. It looks like we'll all be paying a bit more for them over time.
The Americans signing a deal with the British, but critics noted that it's really just headlines. It's just points for further discussion.
Yeah, I mean, I wish I was living in the UK, because what has the UK done? They've cut tariffs on wine. They've cut tariffs on ethanol, which makes beer. They've cut tariffs on beef. Yes, ethanol is used in beer production, on beef. So basically you have steak and wine in the UK a lot cheaper than you previously could have done. But the UK actually has a trade deficit with the US. So, you know, it's symbolic. It doesn't really make much difference. And I wouldn't read too much through to it. But perhaps the 10% kind of tariff floor that they're talking about with the UK, that may well be a sign of things to come.
And you're in the camp that thinks that this may just be introducing a sales tax on the sly.
I'm not sure it was planned, but it seems to me we're heading that way, because the US is one of the few countries in the world that doesn't have a federal, a universal sales tax or a VAT, value-added tax. I think it was interesting when Amazon talked about highlighting the effect of tariffs on products, that kicked off just a hornet's nest. So they want to have it hidden, but ultimately we might end up with somewhere between, call it 20%, tariff on, or tax, sales tax on imports, which would raise several $100 billion a year if things don't change.
But ultimately paid by American consumers.
Absolutely.
In terms of goods not being available or higher prices.
Yeah, I think you're talking about, you see shipments in terms of container ships coming from China just sort of falling off a cliff, and worries about empty shelves and stuff like that. I believe the administration in the US will step back from the brink with that, but ultimately it's a tax on imports, it's a tax that US consumers pay. It's not us being punished or other countries being punished, it's the US consumer that will be punished.
The markets, certainly the S&P 500, you caution, are still not that cheap.
Well, we're back at the levels we were at the beginning of the year. Coming into this year, we'd had 2 years of 20% plus performance. Earnings are pretty high and probably have some downdraft from tariffs and slower economic growth. And you're paying over 20 times earnings. I think 22 times forward earnings today. That is not bargain basement territory. We've talked in the past about longer-term measures like the cyclically adjusted price earnings multiple. Again, that's in high territory. That being said, and I keep bashing this kind of drum, is there's always opportunities. There's always sectors, there's always pockets of the market within countries, abroad, where there are opportunities to deploy one's capital.
You have some stock ideas for us, and one you acknowledge is a bit of a contrarian idea. Magna International, with these threats to the auto business. Auto prices may go up in the United States, for example, because of tariffs. Why do you like Magna at this stage?
It's not the typical type of stock I tend to talk about here on this show. I like quality, I like high free cash flow margins, I like growth, economic moats, all that stuff. This is none of that. This is a real contrarian recommendation. Every time I look at Magna, and I'm a real numbers guy, is the business is much better than people give it credit for. Investors like to shun the stock. It's right in the teeth of the tariff fears. Ultimately, it makes between 4 and 6% operating profit margins every single year, regardless of what happens with the environment. If it continues to make those margins, which it probably will make this year, trading on 7, 8 times earnings, that could be the low point of earnings this year. sometimes it pays to be contrarian.
And they're deeply embedded in their customers' businesses.
Yes, so they have 400 plants around the world. So if you're GM or BMW, you'll have Magna effectively opening up right next door to you to supply you with your auto parts. And that's why you get that almost guaranteed operating margin every single year.
Toromont Industries, we know investors are wild for Finning right now, but Toromont is another heavy equipment dealer. What attracts you here?
We actually bought both. It was the most recent additions to the Canadian growth strategy. We bought a half position in Toromont and a half position in Finning. We like them both. They both have, one is operating Toromont in the east and north of Canada, one in the west and in Latin America. The local monopolies. If you want to rent Caterpillar heavy equipment in eastern and northern Canada, you have to go to Toromont. There is a cycle. There's a construction cycle, a mining cycle, but these are high return, fairly capital-light businesses with great market positions and long-term relationships with CAT.
We'd better jump. Martin, thank you very much. Always great hearing from you.
Thanks.
Martin Cobb, Senior VP Equities at Lorne Steinberg Wealth Management. Up next.